The first day today has actually got the most slides, and we do the analysis of tax revenue performance. So why do we want to analyze tax revenue? We want to see the trends in tax revenue. I tell you what, of all the forecasting that are done in the world, tax revenue is the most difficult. And because we're forecasting on cash flow and not on accrual or on tax return data, we've got all these noises or error terms that every time you forecast, you do find an error term because you can't explain all the changes in your tax revenue on a cash flow basis, because on a cash flow basis we know that revenue of previous years can be included, or there could be payments that didn't come through because of compliance gaps, and all that administrative compliance gaps and the cash flow that's coming in according to payment cycles, you know what the tax laws say when you have to pay what. It's very difficult to assess tax revenue collections. So it's to make sense of what is happening in your, if you're going to assess the trends in your collection, to actually understand why, and that's also part of your performance. I mean, if your annual changes in your tax revenue is a performance analysis, and that also determines then your trends and whether it's positively or negatively correlated with economic activities, because in the end of the day, all taxes are levied on economic activities. And then it's very important to look at structural breaks. Now, lucky for us living now, we've seen two very big structural breaks across the world, not only in a country, and that will be the financial crisis in 2009, and it will be the COVID-19 pandemic in 2021. And all the revenue that I've looked through for all the countries are actually showing these huge structural breaks. And if you're not going to take that into account when you're going to forecast, then your forecast might be very misleading, and you might find this is that the trend line or the buoyancy ratio that you are actually using, or your sensitivity ratio or your elasticity ratio, what you want to call it, is actually going to be not giving you a less accurate forecast than what you could have managed. Then volatility. We've seen how volatile are your tax systems after COVID. We know at COVID and with the financial crisis, the volatilities were very high. But which period in your history, if you look back at your revenue, were the volatility of your tax system the least, and when was it the highest? And which tax types are actually causing these volatility? And if you've made policy changes, how did that impact on your volatility? So it's all reports that you could actually draft and analyze your revenue to actually share with your management or your Commissioner General or your Minister. Do we have anyone here from the Minister of Finance or Treasury? All of the revenue administrations. Listen, you are in the best position because revenue administration's got access to all the data. So you can do the most, and you should. For the benefit of your country and for tax policy and for fiscal management of the fiscal framework, you are very important. You are most important. And then to look at the efficiency in collections, it is important to know whether your efficiency in the collection of your revenues are deteriorating or whether you are improving your efficiency ratios. I don't know how many tax jurisdictions here are focusing on the efficiency ratios, but it is important because that's actually what the Revenue Authority does. That's why you're there in the Revenue Authority, is to make sure that you add the value needed in the effort to collect all tax revenue due. And then the last part will then be on the forecasting of tax revenues. And like I said, we're going to focus on two models to do the forecasting. Perhaps just adding on the forecasting of tax revenues, you must remember no model can accurately forecast revenue. What you can try and attempt to do is to make sure that your deviation or your variance from actual revenue to the forecast is the smallest. And some countries will tell you, well, we will accept a 5% deviation in your forecast. And some countries will say, well, our Minister of Finance doesn't want to accept more than a 1% variance. So it will all depend, your accuracy of your forecast will depend on your volatility of your tax revenue. The more volatile it is, the less possible it is to actually do an accurate forecasting. It will also depend on your efficiency in collection. So if your efficiency improves, you should see either over collection or a much closer variation to your forecast. And so if you analyze your revenue correctly, you interpret your trends correctly, and your models are robust to pick up what's happening in the economy, and you've got an accurate economic forecast, you should be closer to your target. And as the year progresses, if you do a monthly, both of the models are monthly forecast models. So if you go on a monthly basis, the further you down the line in your fiscal year, the more accurate your forecast should be, unless something happens unexpectedly that you didn't foresee. But then you should be able to dissect it and say, well, it's because of this that our variance are much bigger than what we expected or anticipated it to be. And then I just want to say, so no model is going to give you the accurate or precisely the revenue. What I have found, what I've read or what I've experienced in my years in the forecasting team, is that sometimes this institution will say, well, I was the closest, my deviation was less than what the revenue authority deviation was in the forecast of revenue. But the moment you open up and you see what was the forecast by tax type, they might have been more inaccurate, because it might be that by tax type, one tax type that was under or over forecasted was made up by another tax. So what you actually should do is make sure that you're accurate as possible in your forecasting of your main tax types and in total, and not only looking at the total deviation. Because that was actually going to determine where can you improve your models or where you have to improve your data. Because we strive to be as accurate as possible. So this is the slide that I was alluding to when I told you when you are going to do your presentations on Friday, please see that you cover these elements in your presentation. So we want to measure and estimate the revenue raising capacity of the tax system. So we want to know if this is your tax mix, because none of us has got a blank slate and now we start with a tax system. We've got a tax system that has evolved over time and new taxes have been introduced. And what you'll find is that there's sometimes a shift from indirect taxes to direct taxes. So you find these structural changes in your tax system to try to maximize your raising capacity of your tax system. So you need to know how do you measure that tax capacity and how you're going to estimate it in total and by main tax type. And then also in terms of tax policy measures, because I think it's easy to bring forth a tax policy change. We know there are always trade-offs, so it might be that if you are going to introduce a new tax policy measure, that you might do it for revenue, or you might do it to to close tax loopholes, or it might be that you want to be more equity into your tax system. So for the tax policy measures brings that wedge between economic activities and how much taxes are paid. And so I think it's what revenue authorities or ministers of finance are trying to do is where can they get the most tax revenue with the least resistance. I think we've seen some examples in our neighboring countries and also in South Africa where they talk about a tax revolt if citizens feel that they are paying a lot of tax and they're not getting the benefits of it. And then I think for you, especially all of us that are part of the tax administration realm, is that we want to know what is the efficiency in our tax administration. So there are different ways of actually measuring the efficiency in tax administration. We can look at the tax extraction ratios or effective tax rates. That's also used to compare countries internationally because it's a common way of measuring a tax effort. The only thing is that we know that GDP if we use total tax revenue as a percentage of GDP, it's a very crude measurement and it can tell you a story or you can analyze it, and we do use it. I'm going to show you one technique on how you can use it with greater clarity on what is it saying to you. And then tax extraction ratios you can also do it, say, for pay as you earn on remuneration, or you can do it for corporate taxes on gross operating surplus. So I think if you've got main tax types that you want to know more about, you should actually make sure that you also have the tax effective rates on the economic tax base for taxes other than just total tax revenue. So that will be nice if you can share that on Friday. And then what is the responsiveness of the tax system to changes in economy, buoyancy or elasticity ratio? Many of you have actually mentioned that you are using the buoyancy ratios. Elasticity ratios just include the tax policy changes. So it takes out the tax policy changes so that you can really see what is the true elasticity or changes or responsiveness in tax revenue to the tax base. So you're not using the more volatile tax buoyancy from year to year. That is a cash flow measure on the tax base. I think to calculate elasticity ratios, you actually need lots of data on tax policy changes, the cost of tax policy changes. So if that has been kept accurate and it's been kept up to date, it's very easy then to use a methodology to take out the tax elasticity ratios. If that is not the case, you are bound to use the buoyancy ratios. But I'll show you some techniques how to overcome the volatility in annual buoyancy ratios from one year to the next year. What I also must caution you about, usually when you do elasticity ratios, it will be over a long period of time. Elasticity ratios, you actually need at least 10 years of data to really get that true coefficient of the changes in your revenue to changes in the tax base that you are putting together in a regression model. And you need also to do it in real terms so that you can you stabilize your revenue so that this don't have a escalating on an exponential way like nominal values will do. I think you said you're using the exponential model. Who's using the exponential model to forecast revenue? There was somebody that's saying they're using the exponential model, and that's because you're working in nominal terms, so you'll see it gives you this exponential, and then I think you might be at risk to over forecast. Another thing about elasticity ratio, so now you've got these 10 or 15 or 20 year data and you got the coefficient, and now you're saying is that this is the true responsiveness of my tax system, for my tax revenues to to the economic tax base that we're using. And I think this would be a more accurate forecast going forward. Now, I'm telling you that the world is changing, and it's changing very fast. The period after COVID looks very much different to the period before COVID. And the period before the financial crisis looks quite different to the period after the financial crisis. So if you know how did your economy by decade has performed, your tax revenue system, and how does it correlate now to that period. If you use elasticity ratio, it will cover the total period. You can put in dummy variables to actually take out the structural changes in the economy, but you still are going to base your forecast on a very long-term trend. So sometimes it is also good to do a scenario if you use your buoyancy ratio, more recent buoyancy ratio, if there was big changes in your economy. And I'll also show you how to use those buoyancy ratios, or how to make sure that you've got a more accurate picture of how tax revenues are going to perform against your forecast of your economy. Then the volatility of the tax system, it seems very difficult, and it's really very simplistic. It's based on financial measures, so it's what they use in the investment sector to look at the volatility. You will always hear it's 1 standard deviation or 2 standard deviations away from the mean, so that is just the standard deviation from the mean, and then you can calculate the volatility of the tax system. We've put it together in a very nice model so that you could actually at a glance see what happens to the volatility of your tax system. And like I said, not only what is the current volatility of your combination of taxes, but also if you're going to do policy changes, or you've got different periods that you are actually comparing your volatility status of your tax system. Then the Gini coefficient, we're not doing it in this leg. We are going to do it in November. So we're going to look at the Gini coefficient. For that, we need the data analytics on personal income tax. And then I think the importance of the informal sector, especially in Africa, is quite a big factor. And then looking at the sources of change, the revenue raised by the economy and the revenue collected by tax administration efforts. So I think you are going to have that in this week's course that we're going to cover. So please see if you can do it for your country data or for your example on Friday. And then the tax compliance gaps, we are going to look at the efficiency factors. So see if you could actually work in some of the tax compliance ratios, either by tax type or in total. Are there any questions on this outline? Because this is what we're doing this week, and this is what I want your presentations to focus on Friday. Everybody okay? Yes. Yeah, so because we're not going to work with the Gini coefficient analysis, and we also don't have the data in the Excel spreadsheets for it. Yeah, so please, sorry, it's I thought we're going to include it, and then I realized that we've actually got a full program for this week, and I think it will fit better into the November when we work with tax return data. Can you see how easy it is? Our job is actually done for us. We must just take what we have, and then we know all the answers. I'm going to show you if you want to use this analysis and use this when you go back, you can do quite a few reports that will be insightful for your managers, and then you can also see if you can't get a research project together for the next ATRM. Okay, so best practices in tax revenue analysis and forecasting. I can't stress this enough, and I hope it's not true this week that we're going to battle too much with data, but you need access to accurate data. So that means if you say my collections for a certain month were X, if you look in 5 years' time, it must still be X. So it needs to be, I think we've got some cash flow expertise in the room, and they work very hard on that. Okay, so so accurate data is very important, and it must be comprehensive. As more data, you can never have enough data, and listen, you will always have too little data. So please make sure that you build databases that are accurate and comprehensive and timely, because we don't want data that's 2-3 years old. You can't say something about next year or tomorrow if you're looking back so far. So, and then I think it's important that it's kept centrally, that it's managed. I think that's how they do it, that's SARS, and that people can't change it, and that everybody can access it. Data should be available to anyone that wants to do analysis or forecasting or want to work on data, because every one of us can make a difference, and that is very important. I've seen some revenue authorities, if I tell them, do you have this data, they say no, and then somebody else in the administration will say, but we do have the data, so why don't he has the data or she has the data? It must be shared, and it must be comprehensive. And then I think very important, and it's not so much our task, it's mainly our statistical agencies and usually our ministries of finance that should give us a macroeconomic baseline and forecast. What we do find is that you might also find private sector macroeconomic forecast and baselines, and you might also find that you've got a unit in your administration that's also doing it. And usually when you do it for forecast for the fiscal framework, you should use the one that's used in the fiscal documentation, in the budget documentation, because you should be using the same baseline. If I'm telling you GDP growth in nominal terms is going to be 5%, but the central bank says it's going to be 3%, and my own unit says it's going to be 1%, I'm going to get very much different answers in my forecasting. So usually what you do is you forecast on your baseline, that's for the fiscal framework. But if you want to do scenarios, you're welcome to do it. Say, for instance, there's a shock to the world economy like we're having lately with the geopolitical tensions and the tariff changes and all the policies that are moving world economic activity. Then you can do scenarios and say what will be the case if this is going to happen, and your model should be able to accommodate that. Okay, and then taxpayer return data and tax compliance data. If we're doing the one in November, the more data you have of your taxpayer return data, the more accurate model you would be able to build to actually do forecast and also do analysis and do policy shocks. And then tax compliance data, there's, I know that SARS is working very hard to report on tax compliance data, and it's very important to know where are your leakages and where are your gaps, and how do you actually, through your tax compliance efforts, are closing that gaps. And then formalize institutional arrangements and the sharing of information. As you need to share information with your counterparts who's helping and assisting you in terms of tax policy formulation and forecasting, you should actually formalize those that way that you're operating and document it and have a mutual agreement. And be mindful of also don't share your taxpayer details. I've seen some taxpayer details that should never have been shared. You must keep that confidential. You can share information. The data analytics team will tell you how they anonymize the data, so it must be anonymized information, or if you sometimes work on averages, you also get out the individual information of taxpayers. And then I think update databases on a continuous basis and ensure accuracy of databases. I can't stress that enough. It's very impossible to do this kind of work if you don't have. Who of you brought your own country data when we asked you to bring your country data? 1, 2, 3, 4, 1. Okay, so it seems that you did make an effort to bring it, because it will be, like Caroline said, it will just facilitate if you work with your own data, so that you are able to see and you recognize your own data. And then as time goes by, we also need to update and refine forecasting techniques and models. Nothing stays the same. I think some of my colleagues in this room that I've known for a number of years have seen some of the techniques and models that I've shared over time, and you will also see there are new ones now. So you have to keep abreast. The world is not standing still. There are new developments all the time, and that's why I always encourage all of you to participate in research. Because if you do research, you update your skills, you update your techniques, and you update your models. I'm currently working with a team on the VAT gap, and I'm learning so much because it's a bottom-up approach. I think Quentin will want to talk to me afterwards. So I think keep on reading, keep on looking at research, and see what can I apply in my field of work, and enhance whatever you are doing and refining whatever you are doing. Okay, then maintain data management practices, data governance. I think you hear it a lot from the data analytics team. Quality checks, backup, and security. If you are working with taxpayer return data, you always need to clean the data and to get it in a readily available. More work is done on the databases than what are done in the techniques and the models that you use afterwards. And then monitoring monthly actual collections against targets. And you should be able to explain those variances. So you'll see if we go through the analysis sheets, you are going to need to explain what do you see in the graphs. I think if you are just going to use the techniques and frameworks and draw up the graphs and do the reports, be careful that somebody don't ask you, so what? If you say, oh, it increased with 9%. So what? So ask yourself the question, when you do your graphs, ask the question, so what? If you state something that you see in the graphs, you have to ask the so what question. Okay, and then monthly monitoring of compliance, revenue, and tax administration efforts, because it's got such a big impact on our revenue collections. And then account for changes in tax revenue due to changes in economic activities, tax policy reform measures, and tax administration effort. And I tell you what, it's no easy task. I know only of one country that has been able to do it up to now. Do you know which country that is? Rwanda. And I saw it. The person from Rwanda came to me, and after I shared the model with him, he came back and he was able to populate it. But it takes an effort and it takes a lot of data. But it was wonderful to see it. And he also did it by tax type and got it in total. So it is possible. I don't know whether I've shared the big model. I think some of my colleagues here actually do have access to it. Otherwise, I can share it again if you want to try and do a sources of change model in totality. The one that we're going to do this week is a much more macro one, and we didn't do all the tax administration changes. Okay. Any questions on this slide? Do you all agree with me on this? Yes.
Can you Can you explain a little bit the difference between the taxpayer return data and tax compliant data?
Okay, tax return data would be like for your personal income tax. You've got all the details in your personal income tax to calculate your taxable income and your tax liability. So you'll have it for say, personal income tax, corporate income tax, value added tax, or even customs duties to get to the taxes due. So it's all that information is tax return data. Yeah, you must remember all of us has got different, we use different terminology for the same thing. Where tax compliance data is, say for instance, you've got outstanding debt. So taxpayers who should have paid haven't paid, so that's a gap. And then you are actually collecting outstanding debt, so that will be an effort from, on collecting then outstanding debt will be a compliance data. So I don't know whether I've got the pyramid that I've used to show it, but if I haven't got it in your material, I can share it with you so that you can see the tax compliance gaps, where they are in the chain. And I'll see then, I'll just remind me then, I'll make sure that I include it and show it to you. Okay. So that's a very important question. Are there any other questions? Okay, so what are the techniques and frameworks and models that we're going to cover this week? So I've tried to summarize it here. I think this was shared with all of you. Yeah. Do you want me to go through it? Or did you go through it by yourself? Must I go through? Okay, so the model or the framework that we're going to cover, I think there's 8. 1, 2, 3, 4, 5, 6, 7, 8, 9. The one that I haven't included was the implicit elasticity model. I'll show you how it works. It's very easy. So there are 8 frameworks and techniques that we are going to cover, or models. So the first one is the statistical analysis of tax revenue collections. This is the part that we're doing this morning. So we're looking at descriptive statistics. We're doing trends, correlations, and compounded average growth rates. Now, in the previous sessions that we had, I had the Excel sheet that will show all this. I think they call it simple statistics. It's like economics 101, stats 101. This time I've changed it. I've used all the techniques, but I've used it on the actual data to see if that won't encourage you to use it more and to see how you can use it. So we need the tax revenue collections in total and by tax type. Then simplified regressions in Excel is for the forecasting of tax revenues. So we're just going to look at the actual tax revenue collections in total and by tax type, and we're going to use economic tax base forecasts. So this is just also done in Excel. I know those that use eViews or other Stata or undated packages can also use it there. Then estimating tax revenue during periods of high volatility. So we assess the changes in the volatility of the tax system and per tax type. And we just need the tax revenue collections in total and by tax type. Then the model that we're going to do on Thursday is then the cash flow tax revenue forecast model. We use the month by month revenue to forecast tax revenues by month for the current year and outer years. Now you can use that same model, say you want to do it a 10-year forecast. There's 2 problems. The further your forecast, your outer years that you're going to specify in the model, the softer the forecast will be. And why would that be the case? First of all, you don't know what the economy is going to do in 10 years' time. So you have to assume what the economy is going to do in 10 years' time. And the second thing is that you don't know how your revenues are going to perform against those forecasts that you put in. So this model works the best. The more data you have in the current year, the more accurate the current year would be. And then obviously for the fiscal framework you need the 2 outer years, so you will also forecast in the 2 outer years. And that might change as the economic forecasts change and as the economy changes, because we're really very uncertain about what's happening. But you should be able, after you've done a forecast and you get the actual, you should be able to know what is driving that variances that you see. I don't have it here, but we used a graph that shows what does the economic forecast done over the forecasting period and what did the revenue does. And most of the times you will see the economic forecast is the most optimistic. Why do you think that would be the case? Do you think Treasury or the Minister of Finance will tell us, listen, I don't foresee the economy growing next year or the year after that? No, they want to be optimistic. They want to tell their citizens, listen, we're going to grow with 5% or 8%. And reality, you might see is that, but my current growth is only 3 or 4%. So what you do find is, first of all, the Ministry of Finance want to be optimistic and inform its citizens that it's optimistic about growth because we're going to do A, B, and C. We're going to invest, we're going to do infrastructure development, we're going to export more. So they have all these rosy color forecasts for the economy going forward, and it's just natural to be the case. Secondly, why would they also over forecast? They want to spend more money. So they want, if they're saying is we're going to get so many billions or trillions of money, they want to say is no, we're going to close the gaps and we're going to tax this and we're going to do these policy changes and we're going to up our revenue game and we're going to collect so much. Why do they want it? Because in the fiscal framework, tax revenue is usually 90% or more of the envelope. And politicians need to make sure that they spend the money to keep the votes. So that is the reality of being in this game. Your task is to make sure that you've got the models, that you state your assumptions up front. You do your forecast as best as you can. You refine it as much as you can with your current knowledge. And if there are risks or opportunities, it's your task to actually spell it out. Okay, so your model must be able to do scenarios, and your model must be able to, and you must be having enough knowledge and analysis on your past collections so that you can explain why you've got variances going forward. So do you see how everything is coming together? Okay, then the GDP scenarios, Nonto has worked on that, I'm sure, to illustrate revenue impact of economic growth and inflation at a given tax to GDP ratio. This is not a fully impact model. You need like a SAM to actually do a full impact model, and for that you need your input output tables. Who's got access to your country's input output tables that's coming from your statistical agency? I think we've asked there for it. So on this one, I'm just using the GDP, and I'm going to show you how I shock it. And now I can see what it does to revenue. The last one, the SAM economic impact analysis, that you should actually have a model like that. I think somebody is saying is they want to know what is the impact on tax revenue. So you calculate the multipliers, and that multipliers is like the coefficients. If you shock exports or you shock any of your commodities that's being produced in your economy, what is happening to your total output and what is happening to your tax revenues, your value added in your economy, and then you can calculate how much is going to remuneration, how much is going to household income, how much is value added on the company sector, and you can actually calculate what is the impact on your economy. So if you've got, but for that you need the supply and use tables of your economy. If you don't have that, I can show you on the GDP scenarios how you can actually do a smaller, more crude macro way of doing it. And then sources of change model. I think I've included the full sources of change model, but I've also added a template or a sheet that you can just calculate it very easily as the months go by. So you just determine the sources of change in your year-to-date collections and how much is coming from the economy, from growth, how much is coming from inflation, and how much comes from tax policy changes and administration. And for that, you need your tax revenue collections in total and by tax type. You need to quantify your tax policy changes and then your compliance revenue. If you do that, you could actually say, well, this is coming from the economy, and this is coming from policy, and this is coming from tax administration. And that will always hold. It's an identity. So the total change in your tax revenue is coming from 3 sources. And every time you think about the change in your tax revenue and you need to explain to your Commissioner General or to your Minister of Finance, why is my change in revenue X? Then you should be able to tell him, so much is coming, him or her, so much is coming from changes in the economy, so much is coming from tax policy changes, and so much is coming from tax administration efforts. It's also guiding you on how to refine your models to actually be more accurate going forward. And then one that I haven't shared with anyone yet, so hopefully I'm not boring everybody, is the tax effort measurement and efficiency performance indicators. So the World Bank has developed a model that we're going to use, and you can download your country data on that database that I've shown you. And then I'm going to show you how you're actually going to see where are your current tax to GDP ratio, where it should be, and how much can it be. So what is your capacity, what is your actual, and what is where it should be. So how much are you under or over where you should be? That is the mean from all the countries that are in the same middle income or high income or low income GDP measurement. And then what is the frontier, where you could actually be, what if you've got the right mix of policies and you've got the right administration effort. And that's very important, because I can remember for many, many years the question being asked in the Ministry of Finance and at SARS, but what should our tax to GDP ratio be? So if I ask any of you here, you should all know what is your tax to GDP ratio, but if I ask you how much it should be, can any one of you tell me how much it should be? Okay, and then the last one is then the SAM impact model. For that you need a lot of data. I've just got a simplified version that I'm going to share with you. Okay, but I don't mind sharing the full models, so you must just ask me, and then I'll share it. I must just remember, what do I need to share for you, sir?
The tax return.
Tax return data and the compliance. I need to show you the pyramid. Okay. Remind me if I forget. I must actually put my note and pen here to actually be here. I've seen some, yes. Okay, so you currently do have a tax to GDP ratio.
Yeah.
Now, I'm asking you, is your tax GDP ratio in line with your country's development and GDP per capita and your democratic stance and your economic, how's your economic environment for your tax to GDP ratio? Is it too low, or is it higher than the mean of countries comparable to you? And then you want to know but I don't want to compare me only to the mean, I want to compare me to the capacity. What is my capacity? So say, for instance, your current tax to GDP ratio is 15%, but I would like to know, what do I need to get to 20%? Because many of you have got a goal that currently you might be at 13 or 14 or 15%, and then some international organization, I won't mention names, will tell you you shouldn't be there. For your capacity, You should be at least at 20%. So what will it take me to get to 20%? But do you know what's your capacity? Do you know what's your capacity? You're going to do that. Yeah, so I'm just giving you, so what I'm now doing is I'm just doing an introduction so that you can see the whole picture. Okay.